Okay, so welcome to 4 Years From Now. Thank you so much for being here. Why don't we start by a quick round of presentations? We're going to start with Mitchell. If you can tell us just very quickly what it is that you do at HP Tech Ventures.
Sure. My name is Mitchell Weinstock. I'm a venture partner at HP Tech Ventures. Been there for the last 7 years doing this job. It's a hybrid job where in the CVC world, you are also a business development person where you're trying to find things for the business units that they can consume and use and ship to customers, as well as investing in startups that help us 4 years from now, 5 years from now, 10 years from now. So we're looking for the future to help the business units in the future, but also near-term kind of commercial opportunities.
Okay, great. Thank you. Martin, over to you.
Yeah, my name is Martin Tantow. I'm a partner with Pegasus Tech Ventures. We're a global venture capital firm based in San Jose in Silicon Valley. We have about $2 billion in assets under management, have invested in over 250 companies over the last 10 years. But what makes us slightly different is our business model. We work with a lot of corporates, which we call our partners, and kind of offer them something like what we call venture capital as a service. So we run their corporate venture capital funds for them, and that in that respect from industries all over, from mobility to pharma to consumer electronics to oil and gas. So it's pretty broad.
Okay, Raymond?
Yeah, I'm Raymond Liao. I'm one of the founding managing director of Samsung Next Ventures. Been with the fund for 12 years, right? We report directly to the CEO of Samsung Electronics, our single LP. We are making one new investment per week. We can make a decision in a few days. Okay, that's how different we are, even versus the typical financial VC. Okay? We focus on early stage topics like generative AI, robotics, infrastructure for 5G or for blockchain. Right? And then the market segments like digital health, fintech, and media tech.
Very good. Hi, everyone. I'm Alex Homke, Managing Director of T Capital. We deploy strategic capital for Deutsche Telekom. That means we invest in companies that have some kind of business link to Deutsche Telekom, the mothership, as we call it. That can be anything from situations where we have existing business engagements and companies are working together, help each other generate more business, to companies that are complementing technology-wise our products, and all the way out to visionary things where we are talking about horizon 2, 3 topics that we think will become relevant for DT in the future. So anything along that spectrum is what we are investing in. And I've been doing this for a long time, previously for VMware in Silicon Valley, also strategic investments in M&A.
Excellent. So we are going to go to the concept, back to the concept of the mothership, not in Star Wars context, but in the CVC context. But before we dive into that, let's talk a little bit about what it means to be a corporate venture capital and how that is different from a traditional financial VC. Maybe.
Sure. So CVCs are strategically aligned. You have to get together with the leadership team of the business unit and find out what they're interested in, what they want to be shipping. And you don't want to really deviate too much from what they're interested in. At least our case, we're very closely tied to them. So once or twice a year, we'll get together, we'll have a coffee talk with the L1, we call the leadership, and we'll ask them, what are your strategic priorities for the year? And once we understand that, two good things happen. One is that all of the minions that work for them that try to talk us into doing things that we really shouldn't be doing, we have a defense mechanism. We can say, we didn't hear that. And also, we know that if we bring something to the leadership that they've asked for, we're absolutely going to, if we're right on and everything's correct about the deal, that they're going to say yes. So it's an important tie back to that, where I think you're not going to see that across all the CVCs. But in our case, it's very tightly tied.
Raymond, do you talk to your corporate that often?
All the time.
Yeah?
Right? A few examples, right? You probably, if you go to a Samsung booth, you see smart things. Or you may have used Samsung Pay. Okay? This all through our effort at Samsung Next. Right? Years back, we acquired smart things, and we incubate them for a few years before they are ready to be transferred to business unit and continue grow, right? And we invest in a small company and then acquire them within a year, become Samsung Pay, right? So those are the examples, right? That's also reflecting our name, the next for Samsung, right? That's how we, envision our, mission is by working with the ecosystem, right? With the innovators out there, we discover the next huge business for Samsung.
Yeah, very interesting. I'd like to add to that. This is actually an area where my team spends most of its time. Speaking with the different business units at Deutsche Telekom, it's a huge operation, obviously, to identify technology priorities where they have gaps that we can help close by bringing external innovation startups into the picture to help our internal business develop their products and solutions faster. So a lot of time spent talking to them, identifying these needs, and this is where we get much of our ideas and deal flow ideas. But then there's the other source of deal flow, which is our team talking to startups directly and seeing interesting stuff, interesting innovation that we then bring back to these same business units, and then we say, hey, how about that? Would this be interesting? Can this help your business? So it goes both ways.
Yeah, I want to say one thing about that. If there's a startup that's 80% of the way it's something that the business unit wants, and maybe we get them to move 5% more in our direction, that might be enough to bring in something scheduled by 2 years, save $4 million in expenditures. I'd rather do something with that and save their budget and their NRE. So it's a really important thing he's brought up.
Yeah. And so, Martin, in your case, you're not kind of reporting into one corporate, but into multiple. So how does that happen?
Yeah, that's correct. And before I get to that, let me also just reiterate on that. I mean, in my life before being an investor, I've been an entrepreneur as well. I've been a founder. I found a few startups, and CVC has also evolved quite a bit from where we are today to what we were when I was founding my own startup. But I think from a founder perspective, we just need to see kind of the additional opportunities from a funding perspective, or even from a top-line revenue perspective. So venture capital usually has pure financial gains. It doesn't matter if you're going into verticals, if you have a niche investor or a vertical investor or a generalist investor. But where we usually start with collaborating with startups is not necessarily on the pure financial gain, but on the specific strategic opportunity that this startup can have with one of our LPs, with one of our corporates that we're working together. And that additional incremental top-line revenue and ROI is often much more interesting for the corporation as well as for the startup that is launching in a new geography, or that has the opportunity to collaborate with new channels. I give you an example. When I founded my startup, 3Scale, we were talking to Red Hat back then, which in the end acquired 3Scale. We were just a few people, 5 people about in the company, and Red Hat offered us to sell our product through their channels, and they had about 3,000 sales agents globally. So we said, wow, from basically selling ourselves to 3,000 people selling 3Scale, that was just an amazing opportunity for us. And if that's channels, or if that's new product development, or whatever it is, I think there's this additional add-on that corporate venture capital can give over regular venture capital or traditional venture capital.
Okay, and how do you feel, generally speaking, about the notion of some entrepreneurs that, they're a bit hesitant about collaborating with corporate venture capitalists, kind of maybe being afraid that the corporate is gonna, in a way, take over and drive the business towards, the direction that they're interested in, maybe like forbid them from collaborating with the competition and so on? Like, are there any kind of stories that you could share in that context?
I think that they really want the startup to do what they're doing. They're not taking the startup on to do something different. You know, I run into this quite often where startups think that they're going to steal my business or run off with the business. These guys don't have enough budget to do the things they want to do internally, much less grab your idea and run off with it. I mean, there's been a lot of bad behavior in the past, perhaps, but you know, the legitimate corporate companies are there to do a deal that will take them forward. They're not there to just kind of run off with your company. That's not what they want to do. We're there to invest in you and help you do better and grow with you and get the upside, and that's why they want to invest. We're investing in the upside. There's nothing better for your valuation than getting a PO from HP. And that's another difference between VCs and CVCs, where if I can get you a purchase order, VCs can't buy your stuff. I can buy your stuff and I can buy your stock.
And at Deutsche Telekom, you also have Hubraum. There's a startup delegation right here, and so you've seen a lot of cases.
Yeah, when it comes to that question that you were just asking about the degree of influence that a strategic could or should not have on a startup, it very much depends on the stage of the business also, right? Very early on, a new startup should be able to attract capital investors who are less strategic, because the world is still open. Any partner, any customer that you want to explore, you don't need to necessarily align yourself too closely with a strong partner just yet. Later stage, when it's more about selling your product more broadly, then yeah, any go-to-market help that you can get is welcome, and this is where a big strategic can obviously help, right? And another perspective maybe is whether the strategic is a technology house, or in the case of Deutsche Telekom, telco is obviously less of a technology house. We don't acquire technology as much as my previous investment place where I was at VMware was doing, right? There we had a very specific interest in investing, working with these startups, because they would basically complement the development of new technology that we're doing. Here it's more go-to-market play, right? So there's a natural longer leash between us and the startups.
There's a really important point to make for startups, was when to engage with a CVC. You know, we can't do things that will have reputational risks for the company. So that means that we're starting at Series A or later, because you know, if you're coming to us with a high school science project looking thing, that's not something we're going to be able to ship. And you have to be careful what you ask for. If we're going to ship something, ship your product, what does it mean to do that? On day one, you're going to ship 54 languages and answer the phone in Thai at 2 o'clock in the morning. Are you prepared for that? So usually you have to have a much more mature company when you're dealing with the products themselves. On the investment side, you're hoping to invest in them and get them to the point where they can do all these things.
Yeah, it's about timing, right? I think quite a few people here talk about it. There's a timing from you entrepreneur side. There's also timing for internal different business units. And the fate of this timing may take several years. In the meanwhile, you have to survive, okay? So that's what we do here, is that we have a full-time staffed salespeople, BD people, marketing people, and HR people serving our portfolio company. Their full-time job is to serve our 300 portfolio companies. They basically meet at where you are. You are pre-seed, you worry about, you know, how can I hire people? We'll give you that service, free. You are Series A, you want to sell to maybe not to big company, but to other small companies. We do cross-sell for you inside our protocol. So basically, we meet you at where you are, where you need the most of the help, okay? Every one of you early stage, your next milestone before, you know, fundraising is always very clearly marked. Most of the time, you miss that. You will fulfill 50% of that. And what do? Okay? That's how we get you there. We want you to survive well in order to work with Samsung. Okay.
You know, if you're a mature company and you're prepared to work with the corporate CVC teams are like your concierge Sherpa. They would know what's going on in the entire company and drop you exactly into the right place. You shouldn't be like trying to dig in and find your way through HP. you should use someone in the venture team to help place you with the people that care most about what you want.
Okay. And so, after all, we're supposed to talk a little bit about the VC slowdown that we've been seeing in the past few years. And we do know, kind of especially in the COVID period, some corporates did scale back maybe on their innovation operations. So I just want to hear from you kind of what maybe crises you've been through, and how do you see, the relative market slowdown from your perspective at the moment?
So I think for us, maybe we took our foot off the gas, but we didn't step on the brake. And despite that, we've done 2 follow-ons. In the first 6 years I was at HP, we never were able to do a follow-on. So a difference between VCs is they're going to do follow-ons. If you're hitting your execution points and moving along, they're very good about building your business and being there for you at each funding round. CVCs can be some CVCs can be flaky, not all. But again, we just did 2 follow-ons, which was something that we hadn't done in a really long time, and I was really happy to see that.
Congrats.
Yeah.
I think, it's true what you're saying. Of course, there has been a slowdown in venture capital, especially in 2023 and Q4 2022 as well. We've seen it in capital raised from LPs for venture capitalists. We've seen it in valuation. We've seen it in total capital deployed. I think, and that's maybe a learning also from this panel, is it doesn't apply so much to CVC as it applies for venture capital, traditional venture capital in general. Also from our perspective, 2022, 2023 have been great years in respect to what the capital we deployed as well as the capital we raised. We put together a new fund over $100 million from a pharmaceutical company, Denka. Our pipeline work, what we do see also at Pegasus as well is our portfolio of startups that is, let's say, some of the companies struggling more than maybe in previous years. So what happens usually then is they're asking us if we can help on a bridge round, or if we can do a round earlier than expected, if we can have an additional biz dev efforts or strategic efforts with our LPs, maybe with other LPs from our portfolio. So this we do see, and we've also seen some companies who did not survive the last 2 years. But in general, and I'm a founder myself, so I think these are great times. And when always there is a dip in venture capital investment, well, it's going to go up from here, that's for sure. So I'm not really worried about this, and specifically not on the corporate venture capital world.
Yeah, I'd like to second that. For us at T Capital 2023, we didn't have any slowdown at all. We were making 5 new investments, 2 follow-ons, deployed 37 million total. So that was business as usual, because Deutsche Telekom kept doing business, was hungry for new technology partners, so that had not changed. But to your point, what we did see, of course, in our portfolio was some companies who were struggling, who were in need of bridge capital, had difficult times getting this from some of the other existing investors, the institutional investors. And then, of course, eyes turned to us. And of course, we are happy to extend a lifeline, invest in a bridge round, as long as we still have this initial investment rationale, right? Because there still has to be that perspective of, are we still providing value to each other on the business side, not just on the funding side, right? And as long as that holds up, we are in a better position to then also do a follow-ons in crisis times.
Yeah, so for us, there's no slowdown, obviously, very busy. But we do see different industry going through cycles, right? For example, 2022, majority of our investment related to Web3 blockchain, right? But you cannot invest when the builders not showing up. So naturally, last year, majority of our investments are in generative AI. So we follow the builders. Wherever they show up in the area that adjacent to us, we deploy capital. So for us, there's no slowdown.
So even in this time where people talk about the VC slowdown, you still sign one deal a week.
Yes. Well, the year before last, we signed 2 deals per week.
Okay. And so internally, how does that work? So like some people might think that from the minute that you get in touch with a corporate and you do the first pitch, it's like forever until you get a deal signed. Is it that slow?
Well, for me, if you already have a term sheet, I'm going to be too late. I need like 3 months of running room from a dead start.
Okay.
Because there's just so much that I have to do to socialize everything between the people that are going to say yes. I've got lots to go through. So again, that tight connection to the company means I have a lot more footwork.
It's funny what you say about the term sheet, right? Because that typically means the 90-day horizon, unless there's a second closing that we can just
barely make the second closing if you're lucky. Yeah. This guy's free. He can do whatever.
For us, it's very different, and we've seen everything. We have, for example, one fund that it's a Y Combinator fund, only invests in Y Combinator companies. Usually, if you invest in Y Combinator companies, they tell you that the funding round closes the same day, right? And you're in or you're not in. And we sometimes participate. Well, it's usually not the same day, but then you push it out a little bit to the weekend or something like this. That is extreme, obviously. This is not our core investments. What we like often is before we invest, we actually invite the company and we invite the startups to do, for example, a proof of concept with one of our LPs that for the fund that this might be interesting in, see kind of if there's a fit from both sides. They have the chance to get to know each other, maybe already doing business together before we do an investment. That's not always the case, but of course, if that happens, then this can be many months or it can be a year, but I would say often beneficially for both sides.
Yeah. For us, we used to operate in that model. It's the typical CVC model, right? What we convince our headquarters is that let's move this org to the latter, post-investment, rather than pre-investment. Because then the business unit would benefit by the broader coverage, right? Because at least for Samsung, the product line is very, very diverse. We have so many different products, and they change all the time. So their challenge is, when there's a new strategy, who should I talk to? In old days, I say maybe one or two. Now I can say, talk to 10 of them. They're all here, right? So that helps. Yeah. Then the natural discussion about POC, pilot, still goes through the same procedure. And the BU has to go through the same thing anyway, right? But that can happen post-investment. So we do the same thing, but just different timing.
Yeah, pro tip, by the way, do not get caught up in doing free POCs. Have somebody show some commitment and make sure they have a budget. Make them pay for a POC.
Yeah. But to Raymond's point, when it comes to engaging with this CVC, and also why it takes 3 months for us to really work through the process, is because we need to understand what the business value is that we can bring to one another. So if you as a startup come to us, it really helps if you understand what that value is that you can bring to Deutsche Telekom. Right? That you're interested in having access to our customers, okay, we'll be happy to provide that, but we need to also understand how you can help us generate more business. You don't need to have that understanding in every last detail, but at least a high-level understanding how the technologies or the product services are aligned and make for a bigger, better story together for the end user, end customer. So if you have that, we are already 1/3 along the way, and we might make it in much less than 3 months. Yeah. But that is something that we highly appreciate if there's a clear understanding of that.
Yeah, I got to do 4 weeks of legal diligence. Then I have technical diligence. Got to make sure there's no Russian oligarchs on the cap table or having CFIUS problems. I mean, for us, there's a lot of things we have to do before we can say, let's keep going.
Yeah, so I think one, go ahead.
No, I just want to reiterate that because I think it's a very important point also how to approach us, and you started it, and I think it's a very, very, very important point in saying, well, I guess all of us, we're receiving sometimes, we could say, too many emails every day talking to us about, their traction and, doubling ARR and so on. I don't think I've ever received an email which said that, our numbers are not great, but, invest in us anyway. But I think there's this one point, especially with CVCs, how to stand out. And I think, you say one third over the mountain already. I think that's really the thing. If the email contains or the approach contains, this is how we would like to work with you. We're having a product, we're having a service that's going to fit with, in our case, we have several LPs that we work with one of your LPs exactly in that way. Because it also helps me to reach out to that specific fund manager and saying, well, look, there's the startup, they can do exactly that for you. And if that is within our investment thesis and in the niche that we're looking for, this is a big deal. This is really interesting. Almost forget about that you doubled ARR. Sure, you can add that as well, but this is interesting. So approach us with that approach.
Excellent. So what I'm hearing from you, and I think the main tech back from this panel, and thank you for everyone that's been listening in, is that the CVC world is very diverse in the sense of having very different models, very different interests, very different roles on the team as well. The processes might be different, but maybe the key message to the founders who are listening in is to do your homework and to do the due diligence on your side and understand very well who is it that you're contacting and come with your absolute best offer, demonstrating that you have taken the time to understand what the CVC is looking for. And before we wrap up, because we have very little time left, I want to address the elephant in the room. So there's a female moderator in this session. For male speakers, where are the women in the CVC industry? What is happening?
I think Ottilia couldn't come because they cut their travel budget. But.
They couldn't make it.
Well, at least I can say for my team, we are truly 50-50 from juniors to seniors. But it's difficult to hire the right talent, including diversity requirements. So I think I was lucky to get to where I currently am, that 50-50 split. But the talent, the candidates that are coming in are not 50-50, right? That's where the problem begins.
Yeah, well, I think I'm just calculating. We're probably 30 to 40% investors are women. And for us, it's also important, right? Because we deal with consumer. Women has a special understanding of consumer. So to me, it's actually a diversity is such an important business, thinking there, right? Is that how can you understand the consumer behavior and find the right technology to serve them? Yeah.
Yeah, well said.
Well, just on our side, we're definitely below 50%, especially on partner level, and certainly room to improve. However, on the other side, the startups and the companies that we do invest in, I think we're getting closer to 50% for sure. So I think this is certainly something on the upside.
Good. So I think CVCs play an important role here, and you guys can definitely make an impact on kind of facilitating more diversity across the board. So thank you so much for sharing your thoughts and experience and expertise with us today. I hope this was an engaging, interesting session for everyone. That's all the time we have today. So thank you so much.
Thank you.
Thank you.